Hello everybody. Now that you have learned some of the basic parts of Forex trading and you're starting to understand the terminology that's used and you've had a chance to practice with your demo account and you're getting familiar with MT4, it's time that we move on. It's time that you build on this foundation that you already have and start to learn some strategies and techniques that will help you to become a successful Forex trader. So what I'm going to share with you in this presentation is a simple strategy, yet a very powerful strategy. It's a strategy that I have used for several years, and in fact I have it on all of my charts. So if you're ready, let's get started. This strategy is called price action strategy, using something called the T-line and the Doji. And what you will learn during this presentation, you'll start to understand what is the T-line, all right, and how to use the T-line. And then you will understand the importance of the Doji candle, which is a major candlestick formation. And most importantly, especially for beginning traders, you will be able to see and choose high probability trades. This is really key to becoming a successful trader. You've practiced with your demo account, you see candles moving up and down, but the question is always, when do I buy? When do I sell? What is the correct entry point? When are you going to make that trade so that you can make a profitable trade? So that the candles will go in the direction that you expect them to go. All right, it's always the most difficult part of understanding Forex trading. But from this strategy, you'll be able to spot and select trades that are very, very likely, not always guaranteed, but very, very likely to go in the direction that will be profitable for you. So first of all, what is price action strategy? Well, when I learned trading, I had so many lines and different things on my charts that I couldn't hardly see the candles. Well, price action strategy is simply trading based on price. There's either no indicators or one or two simple indicators, easy to understand indicators. What you're doing is you're reading the candlesticks, assessing the price movement at the moment. In other words, every time you open your chart, you should ask yourself the question, who is in control of price? Buyers or sellers? That is price action strategy. And in this T-line and Doji strategy, you're going to see how price action strategy works. What we will look for is certain candlestick formations. And we're going to use a major candlestick, which is the Doji. And there's several different types of Dojis. And what the Doji will tell us, it will give us reversal signals. Now this is really important because you know that currencies and commodities only fluctuate, right? They go up and they go down. They go up and they go down. They'll go up so far, and then what do? They reverse and start to come back down. Or they go down so far and they reverse and start to come back up. So if we can spot those places where it's time for the currency or the commodity to turn around, that will increase our chances of making a profitable trade. Every candle tells a story. All traders all over the world use candlesticks for charting. Whether it's trading futures, options, stocks, Forex, it doesn't matter. This is the common form of charting that's used for trading. And it's because candlesticks tell a story. For example, this graph that you see here, on the left there you have red candles coming down. Well, that's red candle is a bearish candle, as you know, all right? So the sellers are in control. But then when you see a big bullish candle, like the green one on the right there, the buyers are in control. And that's the question, again, that's the question you should always ask when you look at your chart. Who's in control of price? This example shows you, starting off, the buyers are in control and the price is moving up. And then it only comes to a certain level, which is what all currencies and commodities do. And then the sellers jump in and try to push the price back down. Then the buyers say, no, 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 no. They start pushing the price back up. And this goes on for a while until eventually there will be a breakout, either a breakout higher or a breakout lower. In this particular example, the buyers won the battle, and it broke out and continued higher. So what we're using in this T-line and Doji strategy is the Doji candlestick. The one you see on the left is a typical Doji. It's common. You'll see a lot of them. The long-legged Doji, you'll see them sometimes, okay, but not so common as the typical Doji, the small one. And then occasionally you'll see a dragonfly Doji or a gravestone Doji. And you understand, I've talked about these Dojis before. What they are telling us is that the price started at a certain point. It went up, went down, and came back. And at the end of that time frame, the price closed at the same price where it opened. And that is true with each Doji. Whether it's a long-legged Doji or just a typical Doji, the same thing is going on. With the dragonfly Doji, the price started at the top, then the price was pushed down by the sellers, and the buyers jumped in, pushed the price all the way back up, and the price closed at the same place as where it opened. And with the gravestone Doji, it's the opposite. The price started very low, the buyers pushed the price way up, and then the sellers jumped in and pushed the price back down, and it closed right where it started. So whichever Doji we're looking at, the story is the same. It's telling us there's indecision in the market. And that is very, very important. When there's indecision in the market, what the Doji will usually indicate is a reversal in trend. If you have a bearish trend and the candles are coming down, and then you see a Doji, that should be like an alert that possibly there will be a change in direction and the trend will start to become bullish. Or the opposite might happen. You see a bullish trend, then you have a Doji. That is an alert that there could be, from this indecision, a change in direction, and the trend would become bearish. Now, there are about 75 different candlestick formations, but you don't need to learn them all. All right, there are actually 12 major candlesticks that you need to understand. And the ones that we're going to use here is the Doji, all right, the 4 different Dojis that I've showed you. But I would like for you to be able to learn the major candlestick formations. And I have this little PDF manual. It's about 25 pages, which I give to all of my students. And it's easy for you to download this for free. Just go to this website. This is the author of this nice little small PDF manual. The major candlestick signals, 12 signals to master any market, all right, StephenBigelow.com. Just go down there, and on his homepage, all you do is fill in your email address, and he will send you this PDF. So in this T-line and Doji strategy, there are 3 simple things we're looking for. First of all, we're looking for the Doji. Okay, we look at our candlesticks, and we're looking for that Doji. One of the 4 Dojis that I just talked about. Second step that we do is we check our moving averages. All right, and the one moving average that we call the T-line is the 8 exponential moving average. And on the template that I give all of my students, it's usually yellow in color. If you don't already have that 8 exponential moving average, you can simply add it to your MT4. It's called the T-line, or that's short for trigger line. And then the third step that we follow is to check the stochastic oscillator. Now I'm going to show you examples of how this is used. It's easy to spot, easy to understand. It's not rocket science. It's a very, very simple strategy. But you are going to see how powerful this is. And it works on all time frames. 5 minute, 15 minute, 30 minute, 1 hour, daily, it doesn't matter. It works on all time frames. That's why it's so useful. Some of the examples I'll show you here are on the 1 hour time frame. Now I've highlighted in blue on the left, in the upper left hand corner, the Doji. First we have looks like a bit of a bullish move, moving up, and then you get the Doji, and this is a 1 hour time frame. Okay, so 1, 2, 3 hours later, 3 hours later over here, you have this big bearish candle that broke below the T line. That's this yellow line here. Okay, this is the 8 exponential moving average, and this bearish candle closed below the T line. So step 1, we've got the Doji. Step 2, we've got the candle that closed below the T line. We check our T line. This candle closed below the T line. This is a sell signal. So we sell, we go short on the very next candle. And then we just ride that down. Follow the trend. And it goes all the way down to 260 pips. Now this is overnight. It's a long trade. These are 1 hour candles. So probably, even if it was me, I would probably just take 100 pips and close the trade and then sleep really good. Or you can let the trade run overnight. You would just move your stop loss down so that you protect any profit that you had before you went to bed. Okay? Or you can exit. But don't ever think that you're going to get 260 pips. You're not going to get every pip from right here all the way down to right here. Nobody does that. Okay, be happy if you get 150 or 100 or 50. It's okay. Don't be greedy. I've said this so many times in all of my courses. Don't be greedy. You can take profit anytime you want. But never, never do we have an exit signal here. All right, we can stay in the trade all the way down. How do we know it's going to continue down? You watch the candles. This 8 exponential moving average is dynamic support and resistance. So up here, this broke through support, and then once it breaks through support, the moving average becomes resistance. And nowhere did it go above and close above resistance. Nowhere. It went above here, but it didn't close above. So nowhere do we have an exit signal on this trade until right over in here, halfway through the next day. But again, you probably close your trade either the night before, or you wake up in the morning, you still have some profit, and you close it here. Or you can be moving your stop loss down and you follow the trade. But you don't have an exit signal until the candle will close above resistance, above the T line. All right, so on this same chart we have another Doji. All right, this went pretty much sideways during the day. Then you've got this Doji, indecision in the market. Okay, then the next candle, it closed above, it broke above resistance and closed above resistance. So you buy on the next candle. And then you ride that up. That's 1, 2, 3, 4 hours, 120 pips. And you don't actually have an exit signal until the signal on this one here closes below support. But you would probably, likely, most people will, you ride it up for about, say, 80, 100 pips, and you're happy with that, and then you close the trade. So step 1, you spot the Doji. Step 2, the T line. And what was step 3? I didn't show you that one yet. Step 3, we come down and check the stochastic oscillator. So step 1, we have the Doji. Step 2, we have the T line. And we look down here and we see, yes, it's in the overbought area. And the blue line has started to cross the red line and is pointing down. So that gives us an indication that this has been overbought and it's starting to come down, the price. And that's Doji, T-line, and stochastic. Same thing over here, Doji, T-line, and stochastic. And we see, although this is mid-range here, that's okay. The stochastic is starting to point up as the candle starts to move up. But we don't trade based on the stochastic. We just try to get a confluence of indicators, a confirmation from the stochastic. The key here is the Doji, and then the candle breaking below support, or in this case, breaking above resistance, and take the trade on the next candle. So this one here, Doji, okay, number 1. Number 2, the T line, This candle closed above the T line. You take the trade on the next one. And that goes up 525 pips. Okay, so Doji, T-line, and stochastic, step number 3, look at this, coming out of the oversold area, starting to point upwards, and 525 pips. And nowhere did we get an exit signal. This did not come back and break and close below support. Here it closed above resistance, and then above resistance, now the T-line becomes support. And it stays above support all the way up here. Remember, your T-line, your exponential moving average, is support and resistance, dynamic support and resistance. Came over here, it dropped down a little bit below, but didn't close below, so we stay in the trade and ride that up to here. We don't actually get an exit signal till this candle over here. But again, you would have been happy with 200, 300, 400 pips, or you're moving your stop loss up along the way if you stayed in the trade, or you can ride it up, but again, you're never going to get every pip from the very beginning all the way right to the end. Now you see some other lines on the chart, just disregard those because they are not affiliated or associated with this T-line and Doji strategy. The white line is a 200 moving average, and the green line is a 3 exponential moving average, but they're not part of this T-line and Doji strategy. The T-line is the yellow line, the 8 EMA, and that's all that we're focused on. So let's look at this one. Now that you understand how the T-line and Doji works, we have the Doji, we have the candles closed above resistance, so do you buy or sell? Step 1, the Doji. Step 2, the T-line, and the candle has closed above. So do you buy or sell? Look at the stochastic. It's already coming up, already coming well up. It's almost into the overbought area. So would you buy or sell? You buy. Okay, remember, we don't trade based on the stochastic. We're trying to get confirmation from the stochastic. But the stochastic can stay overbought for a long time. Look at that. From the beginning of this trade here, it's already into the overbought area and stays up there till the next day. And that's not unusual. It can stay overbought or oversold for a long time. The key is when you see the Doji, the indecision in the market, and then a break above resistance, and the candle closes, you buy on the very next candle. Now that's on the hourly time frame, but as you know, it takes a long time for the hour to finish. All right, so you sit there and you wait for that one candle to finish before you can actually take the trade. I like to use this strategy on either the M5 time frame, the 5-minute time frame, or the 15-minute time frame. I'll give you some examples on the 5-minute time frame. Okay, this is a 5-minute time frame. And what do we have here? The Doji. Yeah, and then a big drop down with a bearish candle, broke through support, and so we sell on the next candle. 1, 2, 3, 15 minutes, 35 pips. Not bad. Okay, it's very, very good. You're only looking at the chart for a short time. You spot the Doji, that's like in a be alert, and then the very next candle closes below support, so just take the trade. Take the sell trade on the very next candle. And you look down here at the stochastic, and that confirms. As soon as this candle came down like that, stochastic broke out of the overbought area and started to point downwards. So you confidently take a high probability trade as soon as that candle closes below support. Here's a buy trade where, we have 4 Dojis together. That's even more significant. It's like they're waving at you, screaming at you, hey, something's about to happen. So the next candle closed here, just closed above the T line. All right, so you can take your trade on this next one. And that was a big move up. Came down a little bit and then started to go across, okay? And then it went up 75 pips. So these are 5-minute candles. We're looking at about over an hour here. But a good profitable run, 75 pips. And we never had an exit signal. Now here, the candle started to get pretty far from the 8 EMA, and the 8 EMA is taking the average of the last 8 candles, taking the average price from the last 8 candles, so the candles will come back over, get close to the moving average, and then it continues up. So nowhere did we have a candle that closed below support and told us to exit this trade, until over here. But for sure, you're probably likely after this big one here to close the trade with about probably 60 pips or so. And here we have another doji right there, highlighted in blue. This candle closes above resistance. Look at the stochastic, making a move out of the oversold area, starting to point upwards. You just take a buy trade on the next candle and ride that all the way up. Nowhere do you have an exit. Just here you could have, okay, that's an exit signal. It's closed below support there, all right? Or you could just, you're watching it, these are only 5-minute candles. You could watch it and then close it manually. Or if you watch it and you see that the next candle starts going back up, then you'd get a little bit more out of the trade. And this trade here is about 2 hours, that's 176 pips. Now you're probably asking, well, where do I put the stop loss? Okay, well, if you took the trade right here, you'd put your stop loss maybe say 20 pips below, 20 pips below down here, so that when this started up and you do your buy on the next candle right here, you'd have about 20 or 30 pips for stop loss to protect you. All right, you don't have to put it too far down. And if it doesn't work out, and it starts to come back down, then okay, you get stopped out. But always put the stop loss and protect your trade. But what we're focusing on here is your entry point. You already have learned how to set your stop loss and your take profit. What you need to learn is when to enter the trade. When is the trade likely to go in your direction? And if you use this criteria that we've been talking about with the T-line and the Doji, you can see that this gives you the edge, because these candles have either broken above resistance or broken below support, and that after a doji they're likely to continue. And just one more example, you have 2 dojis here. This candle closed above, and so you buy on this candle, but then you get a little bit scared because it starts coming down. That happens. Sometimes the market does that. But it's just the one candle. It was only 5 minutes, and then it took off. And you made a really, really good run here. And then at the top of that, you had a doji again. So you wait 5 minutes, 10 minutes, 15 minutes. This one closes here below support. So you take your trade on that one and then ride that down. Now I like to use this on gold. You can use it on currencies, you can use it on gold, you can use it on oil, you can use it on anything. And this is a 5-minute chart again, okay? And you see we have a bearish trend here coming down, and then what's that right there? Doji. All right, right there's a doji. So I had to wait 5 minutes, 10 minutes, 15 minutes, 20 minutes before the candle closed above, and then I took the trade on the very next candle, and it started to move up. Here's another one, actual trade on the 26th of June, 2020. There's the doji. Candle closes above support, above resistance, and then continues up. Oh, look at that nice run there. And nowhere, maybe perhaps right here, you'd be thinking, well, that's closed below the T line, but again, it's a 5-minute candle. Just let that candle close, and then wait till the next candle starts, and you can see clearly, okay, the trend is continuing. Sometimes it'll be right on the edge. It's not a cut and dry situation where, you know, oh, that is actually just below the line, so I should exit the trade. No. Okay, you have to be a little bit flexible, all right? And here's on the 15-minute chart. You have a bullish move up and then 2 dojis. Okay, again, a very big alert. So you have the candle here closes below, breaks through support, and then you short, you sell on the next candle. And then you ride that trend down. Okay, now here's what most people do, unfortunately. You've got the Dojis here, right? Okay, you turn on your computer, you open it up, and this is what you see on your screen. Okay, you've got the Dojis here, and you see, wow, look at this. This is fantastic, man. Sell, sell, sell. So you hit the sell button. Well, that's an emotional trade, okay? There was no planning in that. You didn't work things out. What I'm saying is you open your computer and it looks like this. You see a chart that looks like this, a big drop. And you don't want to miss out. Nobody wants to miss out on a big trade like that. So you go short right down here. Sell. Something's going on. This is dropping like a brick. Well, it didn't go any further. All right, in fact, it went sideways. It went down a little bit here, but then came right back up. And then it came up, and then it came back down. So now you're kind of stuck in this trade because you went short right here. You sold right here. And now you're stuck in this trade, and you can't do anything. You're waiting to get some profit so you can get out of this trade. And then what happened? Oh my goodness. It turned around and went the opposite direction. So you got stopped out. Don't ever trade like that. Don't ever open your computer, you see a big move, say, wow, I don't want to miss out on this. That's called FOMO, fear of missing out. And everybody does it. It's what most people do. Do this instead. Okay, when you open your computer and you see something like that, take a deep breath. Resist the urge to react to what you see on the screen. Accept the fact that, hey, you just missed the trade. It's already done. It's gone. Okay, nothing goes to the bottom of the ocean. If it's moving up, it doesn't go to the moon. They'll only go so far until they reverse. Always think about planning your trade and then trading the plan. That should be your motto as a Forex trader. Plan the trade and trade the plan. And if you do that, if you plan the trade, the market will come to you. And then you just trade the plan. You cannot force the market. You cannot force the market. Plan your trade, let the market come to you, and then trade the plan. Okay, a summary of this very, very powerful, very, very simple strategy. It's good for beginners. It's good for advanced traders. I still use it. I've been using it for years, and I still have it on all of my charts. The T-line and Doji strategy. Look at the candlesticks and look for the Doji. Easy to spot. Check your moving average, which is the 8 EMA. We call it the T-line. And then check your stochastic. Now, if you'd like more in-depth information on this strategy, go to my website, rickrayfx.com, and there's a tab that says strategies. Just click on that. I have some text about this strategy, and there's also an hour-long video from the mentor where I learned this strategy several years ago, Stephen Bigelow. He does a 1-hour video and gives tons of examples, and if you want to review this and see how he teaches it, that's fine. But that's all available at my website, rickrayfx.com. Okay? Any questions or comments, let me know. My Telegram ID is at rickrayfx. Thanks for watching this. I appreciate it. Take care. Have a great day. Bye-bye.